How do I invest in real estate with no money using partnerships? Well, it can be tricky to invest in real estate because sometimes you don't have enough capital. You want to start very early, but when you're young, you just got a job, you're saving for your retirement, maybe you're putting some money aside for real estate, and at the same time, you have ambitions to start learning and managing real estate. We discuss different ways for you to get into real estate, to invest in real estate with little to no money. You can watch the video up here. It just basically says there are 3 ways to invest in real estate, which is house hacking, partnerships, and lastly, private or alternative lending options. We already discussed house hacking, and if you want to know more about house hacking, you can watch this video. We went into details about house hacking, pros and cons, what do you need, and if it's good for you. Now, in this video, we want to discuss partnerships, which is very important. We want to see how you can use partnerships to invest in real estate where you have little to no capital, little to no money, and you can use like-minded folks to partner with you to invest in real estate. In this video, first we'll go through what are the best practices for a successful partnership based on my personal experience and experience of a lot of folks in hedge funds, private equities, asset management companies who I work with as well. So these are all of our experiences, things that worked out for us, things that didn't work out for us so much. I personally have been involved in 2 partnerships so far, and one of them was really good, the other one was not so good. So I can tell you what are the good things about getting into a good partnerships and what are the roadblocks and pitfalls to avoid when you're in a partnership. And then we'll go through methods of partnership, types of partnership that are very common in real estate. Quick note before we get into the best practices and methods of partnership. Obviously, we're focused on real estate investment and investing in a business that's real estate, and we're managing the holding company. However, this doesn't have to be real estate. This can apply to any other business as well, especially small businesses. So if you have a startup, if you have a small business that you want to start, if you want to invest in services business, or even if you invest in real estate holdings, these principles always stand. These are best practices in leadership and partnership, and hopefully it can help you become a better executive, not just a better real estate investor. So these skills translate across different industries. These are the same skills that I learned as I was involved in startups, or when I was involved in real estate deals, or any other ventures that I was trying to get myself into or got myself into. And I always say that run your real estate holding company as a business. Make sure that you have the same level of professionalism, communication, accounting, and record keeping, because you want to be a good business owner, not just someone who invests in an asset and wants to get something back. You're more than just an investor, you're a business owner and you're a leader, so act like one. Alrighty, so let's go through some of the best practices for partnership. Number 1 is find partners who have the same values and expectations as you. What does that mean? That means that you want to find partners that are like-minded, they have the same goals as you, they have the same inspirations as you, and they want the same outcomes as you when investing in real estate. For example, if you are interested in real estate as a business, but you have a potential partner who's more interested in fix and flip, well, these are 2 different goals that you have. So in order to avoid some sort of conflict, you want to make sure that both of you have the same goals, or at least when you're acquiring the property together, you have the same aspirations, same goals, and want to get the same thing out of it. Usually the conflict is when you have a long-term plan for a property, you want to purchase a property, hold it, improve it, and get positive cash flow from it, but your partner is more interested in making money in intervals from real estate, meaning the acquiring of the property, renting it out, renovating it, and then selling it for profit year after year. Well, these are 2 different goals and it might cause conflict down in the future, so you want to make sure that you have the same goals together. Number 2 is setting expectation and social contracting. Obviously, hopefully you did number 1 and you have a partner who's like-minded and has the same aspirations and goals as you. So now it's time for you to set expectations and understand that what are your obligations, what is their obligation, what are they bringing to the table, what is their desired outcome, what do they want to get out of this, and what do you want to get out of this. For example, if you have a partner who is looking for someone to actually actively manage the business, manage the property, make sure everything's okay when it comes to renovation, supervise all that, become a project manager as well as a property manager and a finance manager, and you're looking for someone just to bring capital in, just to help you fill that deficit that you have in your capital, to either help you with the down payment or even actually purchase the property in cash for you, you want to make sure that you're very clear with these expectations, you both communicate these expectations, you both understand that who brings what to the table and what are the desired outcomes. And the other one is that in case things go wrong, in case there's a financial loss, in case there is a potential issue or roadblock that comes in when you're managing this property, things can happen always. Deals fall through, sometimes renovations don't go as planned. The renovations always almost don't go well as planned, so the timeline always changes in these renovations. So you want to make sure that there is a understanding of what are we bringing to the table, how the process is, and how your exit strategy is going to be. And social contracting, also, you are going into a business with each other, so you have to understand that your interests are aligned and you have the same goals. That's fine, but also you want to make sure that from a operation standpoint, you both have an understanding of how things should go. For example, if you have a partner who says, I'm only going to bring capital, and you are a managing partner, go ahead and manage your property. Well, now you have some sort of autonomy. You always want to communicate with them, but you have an autonomy to make some of those smaller decisions. So you want to make sure that you make it clear to them that, hey, make sure that I'm managing the business, I'm giving you constant updates, but just careful when you have any suggestions, any feedback, let me know. But otherwise, I assume that we're good. I have managerial autonomy there, so I can go ahead and just manage the property. This is something that can go wrong, especially with first-time partnership, is that two partners are getting into a business. They're very anxious to get into a business together, and they have a scenario where you have two people, two managers with maybe different mindsets coming in and want to operate a business. This could be any business. In this case, we're talking about a holding company, which manages real estate. And these differences of opinion, the ways that they think is the best to go by, everybody has personalities, there are different egos at play. So sometimes disagreements like that happen. Based on my experience, I felt like it's always best to social contract, explain the duties, and explain your way of working, your working style, your personality, and ensure that your partner understands you. Because the last thing you want to do is that you get into a business with someone, it could be any business, and you don't agree on how to run it. And then you have a clash of personalities because disagreements happen, roadblocks happen, financial issues happen. Some of the things that you don't want to happen in business usually happens, failures happen at some point. So you want to make sure that you can trust someone. And not only that, you communicate that to them, that how things are going to go in case things go wrong. Quick sidebar here is that this is very contingent on you and your partner having the same goals and also setting the right expectations. Obviously, if you have a partner who doesn't have the same goals that you didn't set general expectations, chances are you will have a conflict when it comes to running your business together or some operational or leadership decisions that you might make. And make sure that step 1 and 2 are done before you get into social contracting, because chances are if you have a partner who agrees with you, you have the same mentality, you have the same goals about the business, and you understand what are the duties, obligations, and the goals of each are, chances are social contracting will be very easy. But the last thing you need to do is bring an attorney in and write a partnership contract. Very important. You have to do this for your own protection. No matter how close you feel like you are with the partner, maybe it's a friend, maybe it's a family member, businesses can go wrong. And sometimes people forget about their obligation, forget about their vision, and you want to have a contract where it records exactly what's the purpose, what's the percentage of ownership, what's the structure of a partnership. Is it general partnership? Is it general and limited partnership? Is it something more dynamic like the waterfall model, or is it just cash flow sharing model? No matter what the structure is, you want to make sure that an attorney is brought into this, an attorney writes a contract, all parties agree to it, all parties sign it, and that could be your legal document that you can always reference in case there's a disagreement, in case something goes wrong, in case a partner suddenly you forgot what their obligations are, then you can always refer to that contract. Unfortunately, sometimes I see that folks are very excited to get into business, especially in small businesses. They are anxious, they're starting their business, they're excited, they purchase the equipment, they get into business, they forget to write partnership contracts for themselves. And unfortunately, down the road, if there was a disagreement, there was an issue, if there was a financial disagreement, especially when one partner doesn't agree about how the other partner is spending the money, or just they can't account for everything, sometimes operations get sloppy. Without having a contract, it could be a very ugly legal battle. And unfortunately, even if you haven't done anything wrong, you can be liable. You can be in trouble because you just didn't protect yourself with a really good partnership contract. In real estate, it usually happens when someone brings in a lot of capital to the deal, the other person wants to manage the property, and the person who brings in the capital doesn't agree with the way things are going or doesn't understand where the money is going. And that's always the function of a bad management, but also if there's a disagreement, if there's no partnership contract in place, a partner can potentially abuse it, or a partner can use their frustrations to take the matter to the court, and it's going to be very ugly. You don't want to be in that situation. One more best practice that I want to discuss that doesn't have to do with forming the partnership is actual operations of the business, is that during operating or managing the business, especially if you're the managing partner, make sure that you have a meticulous bookkeeping, accounting, and record keeping at all times. Remember that when you're having your own personal LLC, which is my analytics company, is a single member LLC, I'm the only owner. I can take money out of the account, I can loan myself, I can loan the company, I can contribute to the company, I can pay myself from the company. And the only thing I have to worry about is IRS compliance and speaking to my CPA to make sure that everything's okay. But when you're in a partnership, things are different. Now you have fiduciary responsibility to other partners, to other owners. So they have the right to ask about where the money's going, where the supply's going, how's the operation, and if you're doing a good enough job. So make sure that you have a good record keeping of everything. Send either monthly or quarterly emails about how it's going. Make sure that you have a bookkeeper, or if you're doing it yourself, you do a really good job at it. You understand that every dollar is accounted for, and that not only gives other partners confidence in your operation, confidence in you because you're transparent, you're communicating everything, you also know what you're doing, and then they are very happy with the professionalism and the record keeping that's going on. And then following up on that, please always be honest, be transparent, don't lie, and don't get greedy. Be honest and transparent. Communicate everything that's going on with your business with your partner. Also, if there's a financial problem, if there's a mistake that you made, if there's an issue that's there, always get ahead of it. Communicate that to them, bring them into the decision-making process, be honest with them, be open with them, because in a partnership, this is just personal experience, and I've seen it in partnerships that fall apart, is that you have a managing partner who made some mistakes, or there is just a challenge. Running a real estate holding business is a challenging business, and then they try to fix it. They were trying to hide it and fix it, and just they don't want to look back to the partners. But unfortunately, things went wrong, and if you bring your partners in, if you be transparent with them, that's always the best idea to have. They'll respect you for it, and if there's something that they need to solve for, now all partners are involved in it, and they'll always appreciate it. Obviously, this last part goes without saying. Don't lie, don't cheat, don't embezzle any money. Don't think that, oh, I'm going to buy some supply for this property that me and my partners are running, and maybe I can take some, go to my other fix and flip. Do not do any of that. Not only it's a felony, it's illegal, but it's also unethical. And it's okay if your return from your first investment is not that high. You build a reputation, you're practicing. So always do things right. Always make sure that you do something ethically. And then,
because you have a duty to yourself and other partners to make sure that every money that you make from this property goes back to this business, goes back to this property, and help grow it.
So always be ethical, always follow the law. Don't get any temptations. Don't get tempted to do things that I wouldn't do. Now, on to the methodologies of partnerships. Obviously, there are different ways for a partnership to be formed. There are different compensation models or different revenue sharing models. I can mostly speak to ones I've done or ones I've heard been done and they've been very successful. And I can just explain some of them that are really attractive to me that I look to do in the future. Depending on your leverage, depending on how the partnership is formed before you go into contracts, it could change the dynamics of the partnership. So make sure that you understand what type of partnerships you want and how you want the returns to be distributed. First one is very simple. It's just simple partnership, general partnership. You have usually two partners come into real estate. They bring equal equity, equal amount of work. They are essentially co-business owners, and they bring in 50% of the equity. Also, when it comes to revenue sharing or profit sharing, it could be very simple 50-50 change. Obviously, this works very well with two beginner investors who want to figure things out, who want to mitigate some risk. Basically, the partner carries out half the risk, and they have to bring in half the equity that needed to buy this property. For example, let's say that I love this fourplex and I can't afford it. I can't afford the down payment at least. You can have a partner come in, share the down payment with me. We both put half the down payment in and acquire this property. If we're looking for cash flow and collect monthly cash from a business, we can share it 50-50. If we have an exit plan, we are looking to buy this fourplex, improve it, increase the rents, or rent out the units that are empty and then sell it, we can share the profits 50-50. Obviously, the revenue and profit sharing can change. The dynamics can change. Let's say that I have a partner who brings more of the equity. I do more of the management work. I basically become the general partner or the managing partner and say, I'll bring less of an equity, but it'll bring more of the work. Depending on how you and your partner value equity versus work, you can set a deal that, well, one would get a higher percentage of the cash flow, the revenue that comes in monthly from a business, versus other partner who would get most of the return when the property sold. I've seen different ones. I've seen cases where someone just brings equity only, the other person brings their management skill to it, and they get something called build up. Build up is that for the first year they get only 2% of the equity, no revenue share, no cash flow share. Second year comes around, they get more of an equity, so they have this ladder system that they get more and more equity as they invest more time into this partnership. So if you hold the property for 10 years, they suddenly have something significant like 20-30% equity into the business while not putting any cash upfront, but they did the work throughout these years. They got like a vested interest, and then they can, during the sale of a property, they can get the proceeds or the proceeds of the profit from the sale of that specific property. You can always get creative with these partnerships. These are kind of very simple general partnerships, so you can define the terms as you wish. The other one is more of a commercial real estate, and it's focused on venture capital and you going out there and seeking investors. Usually the dynamic of it is same as a startup. When they want to start fundraising and they have a really good product that they think that the targeted industry can benefit a lot, there is a significant addressable market, and they think that this is going to be very successful, but they need funding to develop and improve their product. So they go to venture capital, they go to angels, they go to investors who want to invest in their business. This is relatively the same. Your business, your product is housing, your product is place to conduct business, your product is real estate. So you're actually going and selling your skills yourself to potential investors to say, hey, bring some money in, I'll use it to invest in real estate for you, and you'll get to benefit from the potential profit that we have. There are different ways a waterfall model could work. The one that I personally have experienced was that an investor was brought on and we said, internal rate of revenue, you get X percentage of that per year. And again, if we unfortunately don't hit that because we didn't achieve our goals, there's something called rollover. So that rolls over to the next year. So if you can't get that percentage or amount this year, you get it next year. But then at the end of it, if we have an exit strategy, when we sell the property, they get up to this amount, X amount, you can define it, of the profits. But if you did a good job, that means that you improve the property enough, you improve the cash flow enough, you improve the NOI enough that property sells at a higher profit margin. You can always say, well, up to X percentage of, or up to X amount of profit was for the investor, and everything on top of it, I can get it for myself. Again, there are different ways that the waterfall model could work depending on what type of property you want to invest in, what are the expectations of the investor. So always when you're going to venture capitalists and investors, be careful, because you have to have a good understanding of what are you getting yourself into, what is the rate of return, what is the profits that are annually coming in your way, and what is your exit strategy, and why do these investors have to choose to go with you and real estate over all of the other asset classes, all the other asset types, and all the other managers. But let's say that you got the funding that you needed, you invest in real estate, you become a general partner. There are different names on it. They call it sponsor, for example. You can have most of the decision making and autonomy to run the business, and investors become basically silent investors who are just waiting for their return. The pressure is that you just have to perform and you just have to produce that return that you agreed on. Otherwise, you didn't fulfill your obligations, and that could be ugly. Personally, I like general, simple partnerships because I like to invest in people too. I had one that was more of a waterfall model. Was really tough because you're working for the expectation of an investor. So even though you have the autonomy, you don't really have an autonomy that you think you do. But when it comes to general partnerships, you are having a partner, you're working with someone, you both have a vested interest in this business, and you're working together to improve the business or to diversify, to go out there and do better things. So just understand that depending on your personality, depending on what type of pressure you're comfortable with, you might want to choose one or the other. Well, there you go. Partnerships done as well. Hopefully you got some value out of it. Remember, you don't have to do this alone. Investing in real estate alone is tougher. If you can't, or you don't think house hacking or private lending is for you, you can always partner with someone. Or if you have the nerves for it, seek an investor. It always works for some folks. It might not work for the other. But if you're a beginner, you want to first invest in real estate, if you can't do house hacking, if you can't qualify, or you don't really want to go through the private lending, alternative lending route, partnerships is always good, meaning finding like-minded folks who want to invest in real estate. They have the same goals as you, they're in the same stage of life as you are, and you both work together, and then invest in real estate. Obviously, things I said in the video, be careful about them, understand them. A lot of these come from personal experience as well. These are lessons I had to learn throughout the years. It was really difficult. Some major losses I had was not doing things like social contracting, or having an attorney write us a contract, write us an engagement contract or partnership contract. So do these things, make sure that you follow these best practices and choose the model that works for you. And I really hope you'll be very successful in your real estate journey. As always, if you want to know about real estate investment, real estate finance, more of the geeky stuff, geeky side of real estate, watch other videos. We have a really good video dissecting house hacking and how house hacking is done. You can watch it here. But as always, let me know if you have any questions. And until then, keep learning.